All right, welcome to the live stream, everybody. My name is Kyle. Here with me is Dan. So we're going to answer your questions. I know we have a whole new little
Fancy, buddy.
info about
Fancy.
us. So we have our emails here. We're both federally licensed loan officers. So we work in all 50 states. And what we're going to do on this stream is we're going to answer your questions. So all you have to do is put a question here in the chat and we'll answer it. We're also going to cover a little bit of what's going on with the housing market, what's going on with the interest rates, data that we expect from the Fed on Friday, or not from the Fed, but that impacts Fed decisions for rate cuts in the future. And we would also love to know, where are you looking to buy? So if you can put in like a city and state down below, we'd love to hear where you all are from. Dan, how's it going?
Doing awesome, buddy. How's the hurricane in Dayton, Ohio? You okay
You know,
over there?
we had some pretty bad storms actually.
We do, believe it or not.
Really? You were getting, I mean, it's
It was really windy. So I
okay.
don't know if that was a part. We are in the windy city, but I don't know if there's there's a reason for it. But I just talked to a guy in Miami right before we went live, and he's like, "It's fine down here." But then we have clients. We had a couple closings in supposed to close in North Carolina on Monday, and those are on pause right now. We had to have the appraisers go back out and make sure the houses are okay. So it's
Yeah.
it's wild out there, man.
Let's see. We have Kate looking to buy in Palm Beach Gardens. We have Anshu in here as well. Again, cool. We'll get to that question. Dan in the Dirt, good to see you. Let's see. We have Bill as well. And what we'll also do is, so we're going to do a couple new things on the stream. We have suggestions for different rate locks, depending on when you're closing. And then we'll also go into a little bit more of some detailed conversation about the Fed. And then I hear Dan's audio is low, so I'll boost that up here. So Dan, do you want to cover what's going on currently with interest rates?
Dude, it's crazy. I don't even, like yesterday, I tried to get in and do a video. You don't even know what to pick right now because let me just retro back. On a normal market, you guys saw I've been doing this for 3.4 years. Kyle messed it up. It's 3.4 years. It's not 34 years. But
No, it's 34. Good old 34.
what normally happens? So what are you seeing right now? We got hurricanes. We got a war, Russia-Ukraine war. Now we got a war in the bombing is in Israel and Gaza. We have the presidential election. It's a mess out there. Then we have the port strike. Basically the East Coast is all under port strike. For goods and services. It's a mess. So then when you look at everything that's happening in the background, like I just went in, the Dow Jones is up today. How? I have no idea. Here's what would normally happen if this happened, 10, 15 years ago. The stock market would crumble. It would just crash because people would move to safety. Again, you got wars all over the country. You have hurricane. It's a mess, and people would get into the bond market. Well, they'd get into treasuries, and they would actually bring down the yields because they would be buying and buying and buying. So you're starting to see some people buying treasuries, but there's too many of it. Okay, I know I keep going back to this. We have too much debt out there in the country right now. So mortgages aren't getting a reprieve from a lot of this because people are still buying stocks and bonds and this and everything else. So my whole thing is we're in uncharted territories. I mean, I've never seen two wars going on, the election cycle we have right now and everything else going on what it is. And the cycle right now isn't bad. Okay, so let's go over it.
Hey, Dan,
GDP
real
came in
quick.
yesterday, over the last few days. It's pretty good.
Oh,
We have the
hey, Dan,
unemployment rates. What's that?
can you, is it possible to turn up your mic just a touch?
I don't even know how.
Oh, okay. I'll see. I think I got you at 100 here, but before you started, I just want to see if I could get it up, but we'll push through.
That doesn't you do it, does it? Okay. My apologies. So bottom line is usually I can go in here and say, okay, and I'll try to talk louder. I can go in and say, okay, here's what's going on in the economy today. Here's what's most likely going to go in the bond markets and the equity markets. So if you said, Israel is going to get bombed last night, I mean, decimated with all those bombs that came through, the stock market would be up. I'd be like, you're crazy. Well, if you go into the Dow right now, it's up 67 points. So it's hard to figure this out, but we know the Fed's cutting. That's the good news. And you can make money on that. And you can also follow mortgage rates down with that. Their projections are cutting 200 basis points over the next year. I don't think they're going to go that far, but the direction that they're going. So don't fight the Fed. Okay, so that's that part of it. So what Kyle created actually just recently is a tool that you guys can use to track rates. So we brought this out because a lot of people bought last year. Like we're a mortgage servicer, so we have over 500,000 loans, FHA loans on the books that are over 7.5% interest rates. So the rates are way up there. So a lot of people are asking us, Dan, when is that time to refinance? So because of all the uncertain times that we're having right now, we actually created a tool, or Kyle created this tool, so you guys can give us your information. We're going to actually put that information right into a CRM. We're not selling it or anything. So basically, we're asking you, what rate would you like us to contact you at when rates get down to where they are? And here, this is the one that shows up on my site. So you're just going to go in there. You're not going to put in personal information like social security numbers and things like that. You're just telling us a little bit about you, your house, your mortgage, and it'll go into a database. And what I'm going to do is I'm going to go in there Monday, Wednesday, and Friday, and I'm going to scrub it. And then I'm going to reach out to those people. If you put in, hey, I want contacted when the rates hit 5.99%. Well, the day that hit, the rates hit 5.99%, I'm going to text you, call you, and email you. I'm not going to be a pest, but I'm just going to let you know, hey, the rate hit the figure that you want. Are you interested in anything? We don't play hard sales here. We're just like, here's our information. Here's this. If you need our help, we'd love to help you. So we created a bunch of tools. So long story short, Kyle came over to me for the economics. It's just going to be a day-to-day thing because we don't know, even last week, I don't know, a lot of you guys knew, but the government was on this close to a shutdown once again, but they passed a last-minute resolution to keep the government funded. So there's a lot of just bad stuff going on right now. So that's what we're seeing. And it's kind of helping rates sometimes and not helping rates in the others. But we have Friday, the jobs report numbers, or the unemployment figures coming out on Friday. And that if it doesn't come in right in line with expectations, it will be a market mover one way or the other. So that's my economics report. So sorry, I can't be precise because it's like, what's the weather going to be in 3 weeks from now? I don't know. But that's how I feel right now on this piece of it, because it's just a lot of things just don't make sense.
Well, and if we kind of look historically what's happened over the past couple of weeks is here, I'll turn our little faces off here. So where we were at initially, we saw the Fed cut the federal funds rate by 0.5%, and everyone kind of expected rates to drop, a full 0.5%, and that didn't end up happening. We've actually seen rates have a slight increase here, but they're on this kind of downward path. And so, Dan, do you think it's fair to say that we're going to continue to see rates kind of on that slow downward path? And also, how are you seeing things with the upcoming Fed meeting that's going to be in November playing into this as well?
So I posted video yesterday, and President or Federal Chairman Powell, he did a speech this week, and it was for the economics committee. And he actually said in there, if the data comes in as we expected, you're going to see multiple 25 basis points cuts. I caught that. And I found a video clipping of it, and I put it in last night's video. I don't think it got a lot of traction because the thumbnail was bad. And I'm like, is October a good time to buy? It wasn't a good title either. But if you check out that video, there's a lot of context in there that could be helpful for you. But the federal, here's what the CME FedWatch tool is. Here's the kind of cool thing about this. I've been using this for about 2 years. A lot of analysts have now this year have picked up on this. So it's not that precise, but it gives us at least a direction. So what you're seeing on the screen right now, the Chicago Mercantile Exchange posts updates this every day. And what it's telling us is what the proposal is for where the federal funds rate is going to be over the next several meetings of the Federal Reserve. So what you have to understand, the first thing is, what is the federal funds rate? Okay, the federal funds rate isn't the mortgage rate, isn't your car loan rate. It's basically interbank lending. Okay, that's all that it is. Okay, so where the federal funds rate was previously was 5.25 to 5.5. They dropped it 0.5%. Okay, so now we're at, 5 to 5.25. So what you're seeing on the screen right here is you're seeing on the left side the meeting dates. So the next meeting is November 11th, and there's a 64.77% chance they're going to cut rates by 1/4. Now, how do we know? Well, because the cell that we're in now doesn't even exist anymore. So it's 5 to 5.25, or 4.75 to 5. Okay. But look at the screen till next year. So where are we going to be October of 2025? Well, this chart's telling us now the federal funds rate is going to be cut another 100 and almost 200 basis points. That's 2% between now and then. I don't think they're going to cut that much. But you're going to see rates continually go down. I'm still saying my pivot point is 5.5 to basically 5.9 for the latter part of this year and basically going into 2025. And that's, I think, where we're going to be sitting for a while. So if you're waiting for 4s and 3s, don't think I'll put it this way. I hope we don't get there, because the only reason we got there in the first place was the whole world got shut down because of COVID. So that should do it.
Sweet. And then,
questions.
we'll go into some questions here in just a second. Do you want to talk about with rate locks real quick? Because I think a lot of people have questions about, if you're currently under contract to buy a house, should you float your rate or lock it based on what rates are doing right now?
So Kyle made this awesome. Well, the 7-day, it says lock, you have to lock. So if you're closing in 7 days, you need to have been locked by now. Okay, 15 days, you're probably right there as well. Most of the time. So let me explain first of all how this works, because you can get a 7-day lock, a 15-day lock, a 30-day lock, all the way out to a 90-day lock. So you put your house under contract now, and then you're like, oh, we are not going to close for 60 days. So should I get a 60-day lock? You can do that. I don't suggest that. In today's market, I would float most of the things from 30 further. And floating means we're just watching the rate and seeing, if it goes up or down. And it's also cheaper. For example, if your rate for today, let's say today's rate is 6.25. Okay. And let's say that rate is par. It doesn't cost you anything to get, but you're getting no credits back. All right. But that would be on a 30-day lock. It gets more expensive if you need a longer lock. So let's say you need a 45-day lock. Well, your rate might be the 6.25, but there might be a 0.5 point fee in there to do that, or your rate might be 6.2. Okay. Then if you go to the 90-day lock, it might be, your rate might be 6.4%, or you might have to pay, a point to do that. So I wouldn't suggest doing any of those. I wouldn't pay fees for that. So that's why I elect just float it. If you're past 30 days from closing, just float it for now. Watch our videos, watch our content, and we'll tell you, if there's a big hiccup in the market and we're like, okay, you need to lock now, I promise you, we'll let you know.
Yeah. And we'll do these rate lock suggestions every week. So as we get, as you might get closer to your closing date, you can follow along here to kind of see our recommendations. And then if this is helpful, let us know. Give us like a thumbs up in the chat, or just let us know if this is helpful for you at all. Because I know on these streams, we have people all the time who are like, should I lock or float, lock or float, lock or float? And it really depends on when your closing date is going to be. So for those people who have 3 weeks or more on your closing, so if you're already under contract and you have at least 3 weeks left, we'd love to be able to help you with a quote. You can go down to this URL right here, whenthehouseyoulove.com/compare. And what we'll do is we'll be able to compare your loan estimate versus what we can offer. And so often do we run into other lenders who are charging so much money in like upfront cost, upfront discount points. And many times we can offer a same rate with no cost or lower cost than that lender. And so kind of what sucks about that is sometimes people will then take our quote and go back to that other lender to have them reduce their costs. But I always think like, I don't want to work with somebody who overcharged me. They like effectively kind of duped me. And then once I got smart to it, then they lower it. And so our goal is to give our best offer, put our best foot forward when we're working with you. So this is a way that you can do that. If you're interested, let's go into some questions now, because we have some loaded up here. Let's see what we have. Anshu said, hey guys, awesome work as always. Do 10-year bonds already have priced in the future rate cuts, or rates can change, drop another 0.5, 0.75 in mortgage if Fed cuts 0.25 each in November, December, January?
The bond market, yes, I think the bond market already has, I think they're more aggressive. I think the bond market already has about 50 basis point cut in it, but the bond market moves all day. You might not realize that, but if you could show, Kyle, can you bring up this MBS Live?
Yeah, just a
You'll
second.
kick me out, but that's okay. I just want to show you guys in there. You can pull up the 10-year Treasury bill, and you could see it moves all day long. So yeah, I think everything's been priced in, but you have major events happening every day. So is that the MBS?
Yeah, I'm going to try to make it a little smaller here. I'm sorry, this is the 10-year.
No, that's perfect. That's perfect. So you can see on here that it trades all day long. So its yield is moving all day long. So right now, you can see it actually just changed while you were on there. So it moves all day long, and it's based on the basically what's going on in the world. So here's what normally happens in a normal market. You see Israel getting bombed. You have Russia invading Ukraine. You have the hurricane. You have all this uncertain stuff. Most cases, they're like, you know what? I don't know how the stock market's going to react to this. I don't know what's this going to do to the business community, the economy, anything else. I'm just going to move my money out of. And I've had many, many friends do this, especially in 2008. They're like, I'm just taking all my money out of the stock market and just putting it into something secure. Well, if that's what you're looking to do, the secure piece is normally a bond, and Treasury bonds are the most secure bond out there, and they're still yielding high yields. So why rates also dropped in the past is Treasury yields were basically nothing, back several years ago. So everybody was buying mortgage-backed securities. So that's basically what's happening. But you can see right here that's it's the bond yield ticked up earlier today, when just whatever news came out this morning. You can see how the bond market ticked up. So hopefully that'll clarify it for you. But the 10-year Treasury moves with every day, all day, with the uncertainties of the markets. And usually it's a good gauge. Like I was going to say, if I saw, Israel getting bombed yesterday, I would be in the past, I would be like, stock market's going to crash, mortgage rates are going to plummet. And it didn't happen. And that's why there's a big disconnect. And COVID threw a lot of the economic data that we have kind of on its ear. Because, if you were to ask me, 3-4 years ago, if the housing market did what it's doing right now, I'd say housing market would crash. But since I lived it and I know what's going on and I do my research, I know what caused the 2008 crash was subprime mortgages, not just because home prices went up. So in this event, I knew that the home sales were going to crash, but home prices weren't. And that's where a lot of home crasher guys are missing it. And they still miss it to today because, Kyle has a bunch of information, and that's what the context of today's video was going to be about. Why is the housing market just stuck? And it's truly because people aren't moving. I've been in my house for 23 years. I have no intentions to move. And, I still have a mortgage on my home. Yes. And it's very low because I take my extra money and I put it in the markets and other equity factors to build wealth. And so that's why I even have a mortgage, but the rate is so low, I just keep the mortgage. So a lot of people have these subprime rate or these way low rates that they're like, well, hell, if I sell this and buy even a smaller home, my house payment goes up. So I'll just stay where I'm at.
Yeah. And wow, what a nice little tee up there. Oh my God.
And you can probably tell I used to do radio.
It'd be so much smoother if I didn't call it out, wouldn't it? So yeah, this article is talking about just that. What Dan was mentioning is how the housing market right now is feeling stuck. And I imagine if you're looking at buying, if you're searching for homes right now, this is not news to you, or maybe I guess maybe for some people. But I know there are a lot of people. Dan in the Dirt just said that they just put a house under contract, and I think Dan, I think you've been looking for months. As you've been following along with us. So only 2.5% of homes exchanged hands. So the turnover on homes is really low. And so this article is talking about it's this toxic combination of record high home prices, elevated mortgage rates, creating one of the most unaffordable housing markets in a generation. And so it goes on to explain how this market has really felt frozen. And a lot of people were thinking the same thing in 2023, that it can't get any worse than this. But we're seeing that traction still being a lot slower. And again, it's because of rates where they're at currently, the impact of inflation as well. And then also just low inventory. That's the main thing that's driving this stalemate here between buyers and sellers, is just there's way too much demand compared to the supply of homes available. And that's why we only saw that 2.5% number of homes actually having some turnover to it. So even though we've seen, rates steadily decrease over this past year, they were, we were seeing rates like up in the eights, the low 8%. And now we're at that, low 6. Some people on things like FHA, VA, those government backed loans getting into the high 5 range. So we're definitely seeing that. That's definitely good for affordability. The problem, though, is this lock-in effect that's happening. And so the CFPB said that nearly 60% of the active mortgages right now have interest rates below 4%. And Dan, when do you think we're going to get to 4%?
Never.
Here, I'll give you your crystal ball here.
Hold on, I gotta go this
Yeah, it's hard to do. It's a tiny little bubble.
honestly, I don't foresee us there in a while. But again, you have to put everything in a context. The markets can change on a dime. Let's say that, I don't know, there's a big coup or something on the election, or let's say the Israeli conflict gets even worse, or Putin does something even crazier, or China gets involved with Taiwan. It can get worse, folks. So, never think because you're at the worst part of it. But the nice thing about what we're seeing right now is, here's my big take on this whole thing. I think the Federal Reserve pulled off something I never thought they would do, a soft landing. You have GDP. So a recession is this. It's 2 negative quarters of GDP. So basically what it is the whole economy just goes to shit. Okay. So what happens is the economy goes to shit. People lose their jobs or get laid off, this and that. And then it just starts a spiral effect going down. Well, the Federal Reserve intended to do this with the rate hikes, and they wanted to cool down the system. So now they are. And so a lot of people are saying, things are going down. Well, that was the intention of all this. And so now what you're seeing is everything's starting to stabilize, which is kind of cool. You got GDP, which is still 2.5-3%. So that means we're not in a recession yet. You have the jobs numbers. ADP job numbers came out today. They were actually 40,000 more than expected. Well, I don't really give them too much credence because they're usually wrong, and they're usually wrong or off by plus or minus 50,000. So on Friday is going to be a huge day. Friday, we get the true unemployment numbers and the unemployment rates. So I'm going to address kind of an elephant in the room. I get on my comments down below and on here and everything when people come out and say, the Fed lies, or the government lies, or this lies, or that lies. Guys, if you don't like the information, it doesn't mean they're lying to you. Okay. So we have to get data from somewhere. I'm not going to take data from like Reventure Capital and those guys who think the world's going to end tomorrow. Well, they thought the world was going to end 10 years ago. And now every year they keep reiterating the same thing. I'm going to take the data. So we watch data, and that's what we're following here on a channel. And so I come straight to you guys every day. I come with an opening bell and a closing bell, telling you exactly what's taking effect each day. That's unfortunately right now in this time period. That's how you're going to have to live it, because one bad piece of information can really screw up the whole system. However, the data that's coming in, if we can put a ceasefire in Gaza, and the Putin, the Ukraine thing can settle down. The hurricane's going to hurt because we're going to have insurance issues and all this other stuff. So as this things settle, the world will settle down. But just watch the employment numbers, and watch GDP at this point, and watch the CPI. CPI is consumer inflation. You watch those 3 things, you're going to know right where the economy is going, and you'll have a good beat on what's going on. And that's where a lot of people. They're like, well, yeah, that went up, so that's got to go down. That's not how things work.
Yeah. Sweet. All right, let's finally get to some questions here. I got
I've been talking way too much. You take some of these.
I got
there, buddy.
No, this is just me being lazy. It doesn't come in here. That's the part that sucks. So once it does, you better watch out.
You should meet my son Patrick. Well, have you ever met? You've probably talked to him 100 times. He works with us. He had a beard, I think, in 8th grade. Like a beard. He's a hairy kid, but that's one of my sons.
I can't do that, unfortunately. Dan in the Dirt said, I keep seeing mortgage rates going up, up, and up. May just cancel the house we finally put under contract.
I'll put it this way, Dan, if a 0.25% or a 0.5% rate, and I'm not trying to be a jerk, I'm truly not. If a 0.25% or 0.5% rate, rate adjustments really affects the purchasing power, I live by this motto: when in doubt, do without. So that's why if that payment's getting a little bit too high for you, maybe just sit on the sidelines and see if rates will come down a little more. I don't think home prices are going to move anywhere. I'm seeing it they're just roadblocked.
Yeah. Bill said, did I mess up not locking my rate yesterday? I'm closing in about 15 days. I think the traction that happens.
Yeah, can you pull up the MBS?
Yeah.
So, Bill, here's what we do. First thing when I hear that is I go to the MBS market to see what the mortgage bond's doing. So we go into there, and I'll tell you, this morning the MBSs were down like 25. That means mortgage rates are going up, and now they're down 10. So you're getting a little bit of reprieve. So let me explain to newbies here with us. What you're seeing on the screen right now, it says over to the side. That's an FHA one, but that's okay. It says,
oh, I'm sorry.
NMA. Yeah.
There we go.
Go to the MBS. What the MBS means, it's a mortgage bond. That's all you need to understand. Okay. This is how your rate gets created. All right. It's the yield on this bond plus LLPAs, and we'll go over that at some other time, plus a profit margin. So you have to know what's going on in the mortgage-backed securities market. So how you focus in on it, how you figure out, it's really simple how this works. If the price of this bond is going down, you have a negative like you're seeing on the screen, means mortgage rates are going up. So you saw it go from 0.07 to 0.08. That's not enough for banks to really reprice things. But you could see,
there were zero reprices here.
Yeah, look at all those orange dots. If you highlight over those, you can actually see what lender did what. So you could see right through there that Mr. Cooper, they reduced their rates. So we watch this all day long, and that's how I track rates, and I can tell you who adjusted their rates up or down or whatever. So right now what you're seeing, Bill, is most of the lenders are repricing loans for the better, meaning they're redoing their interest rate sheets at a reduced price. So now if you missed your rate lock yesterday, you'll probably get the same rate if you look to lock right now, because we had that much recovery in the market. So you didn't miss out. There are days where you'll go in there and that'll be minus 20 or minus 30, and that's when you screwed up and you should have locked in. Amanda's back.
And also to say too, nobody knows what the future is going to look like. So, you gotta give yourself a little bit of grace to say nobody knows what's going to happen exactly. So you make the best guess that you can, you do the best that you can. And that's about it here.
Dude, we're all just we're all people in a little office or our basements trying to provide you as much information as we can. So when you're watching somebody like that, take their word, take what they're taking with validity. But some of it you have to say, okay, you guys aren't on Wall Street, or whatever. So that's why I try on my videos, I'll bring in Wall Street analysts and I'll put their videos up on the screen and do all this other stuff. So you guys get it from Wall Street all the way down to Main Street to, Podunk, wherever. So that's it. Sorry.
Jonathan's calling you out, Dan, for calling out other YouTubers. I told Dan he's gonna be blocked from saying
that's fine. Here's what drives me nuts. It doesn't affect me at all, really. What I hate about it, they're giving you guys the wrong information. So if you had somebody on YouTube saying 2 + 2 is 5, and every day they keep telling you 2 + 2 is 5, and here's why, and at some point somebody's got to call them out and just say, guys, the information you're providing them is not accurate. And I would love to debate with them and just say, I would maybe love to learn what they're thinking. Why do they think home prices are going to go down 30, 40, 50%? And then on the flip side of it, if you ever see how many views they get, those people are probably getting a disservice. Because if you go back to these videos, back in 2020, they were saying it's going to be worse than 2008. 2021, it's going to be the worst ever. 2023, worse ever than 2008. And where are we today? We're basically, home prices are stagnant. So it didn't crash. And that a lot of people put their validity into those people. So they're maybe sitting on the sidelines, renting, doing this because they're thinking these guys really know what they're talking about. So that's why I'd love to debate them. So if you know them and you have good rapport with them, just ask them to come on and just say, hey, let's just talk. God bless them. If they can prove me wrong, everything I'm telling you, I'd be the first one to tuck my tail between my legs and say sorry. But the reason why I'm doing it is because it's giving you guys a disservice. And I don't like bad information out there. I would do the same thing if somebody was teaching my kids wrong information. You got to call them out. And I think that's part of what's wrong with our society today. We're afraid to tell somebody they're wrong because we might hurt their feelings. I don't care about their feelings. So sorry about that.
I just absolutely messed something up, and I don't know how to get you back. I'm sure at some point I'm going to do. I know at some point.
YouTube. See what you did, Bill.
I think I made you. That question. I think I made you somehow into the smallest little square, which I'll correct here in just a second. All right, we need to do a little power session here with some of these questions, and then I will get this. Oh, perfect. That's good enough. For what we're doing here. All right, Amanda said, hello, interested in refinance info, working on an email for you both. Sweet. We also have our email right here. There's Dan's email. There's my email as well. So you're welcome to reach out to either of us. Let's see. Nat Kikuna is here. Arizona, Oregon bound will be in touch. We also have Kaya looking in Delco. Adam said, hello, buying in Albuquerque, New Mexico area. I'm pre-approved. If the rates decrease, am I stuck with the 6.2% rate that was stated by the lender about 4 weeks ago? Thank you. You want to take that?
If you're locked in, just because you're pre-approved doesn't mean you're locked in. So you have to get in most cases, you have to get a house under contract to lock in your rate. Now, there are some things out there like lock and shop and things like that were around for a while. They're still there. I wouldn't suggest doing it because they'll give you today's rate and they'll cushion it. So I would just stay with today's rate, but check with your pre-approval. If you just got pre-approved and don't have a house under contract or anything, you don't have to worry about that lock-in. But if you're locked in, you're most likely stuck. And that's why Kyle gave that information where you can upload your loan estimate to us. We'll review it, get right back with you and help you out.
Yeah. The girl said, I think they may have left, actually. So, hopefully they'll see this on the replay, but, they said, I wonder how often, or I wonder how lenders view age when approving someone for a mortgage, 50 plus. So age is actually a protected class. So when you're getting a mortgage, your age doesn't factor into your approval at all. So I know a lot of people feel like if they kind of think like, well, I might be 60, so if I get a 30-year mortgage, I'm going to be 90. Don't they think I'm not going to be able to pay it back by then? And that's just not how they think about it, because most people don't pay all the way into a 30-year mortgage anyway. They're refinancing into something else. So age is never a factor that really is going to be an issue when you're looking at getting a mortgage. But it's a good question that a lot of people have. Here's one for you, Dan. What does it mean when you buy points?
So buying points is basically you're prepaying. I'll put this way: prepaying interest. Here's the easiest way to figure it out. Okay, so let's say the rate today is 6.25, but you're like, can I get a lower rate? So there's fees. Basically, you can pay a fee. It's like interest to buy down that rate. So we could say, okay, at 5.875, you pay $500 and you can get that lower rate. Now, here's the catchy part. Here's the weird thing. There's no rhyme or reason really between the different increments, meaning this. Let's say 6.25, I'll say is par, meaning you're not getting any credits and you're not being charged anything. But let's say 5.99, there's a charge. The charge might be $500. Okay. But then 5.875, it could be $4,000 or it could be $1,200. We don't know. Every investor's spreads are different. So when people want to buy down the rate, we go into each one and figure out what spreads, what lenders have the best spreads, and we're the best place to lock you in at. So that's basically how points work. In this environment, I wouldn't be a huge proponent of paying points because the Fed's in a rate cutting cycle. So, I would use any monies like seller credits or anything else to pay other costs. At this time, I wouldn't pay it to buy down that rate because we have more room to work. Now, if we were in a cycle where I think we're at the bottom, I'd say pay points to bring it down as low as you want. Here's your break even point. And then if you're going to stay in that house for a long time, then you probably just did yourself a very good service. But that's how points work.
Michael said, if you're good. If your income decreased after paying your mortgage for 10, I'm assuming maybe like 10 years somewhere, or 10 payments maybe, you cannot qualify for a refinance. Can you ask the bank to reset the rate? So it's going to depend on the type of loan that you have. So for conventional refinances, you have to do very similar underwriting to when you purchase the home. So they're going to have an appraisal done, a credit check, and check on your income as well. So they want to make sure you have stable income to repay even for the refinance. Now, if you have an FHA loan, a VA loan, and then sometimes with USDA, you can do this as well. You can do what's called a streamline refinance. And a streamline doesn't take into consideration your income or job. They don't need an appraisal, and a credit check is not required as well. You just have to have on-time mortgage payments to qualify for those. So if you have those loans like FHA, VA, then income won't be a consideration on those streamlined refinances. But if it's a conventional loan, it will be. And just to clarify too really quickly, you can't go from a conventional go to an FHA streamline. Streamlines only work from FHA to FHA, VA to VA, is how those streamlines work here. Let's.
Is my volume okay, people? If you can just give us a thumbs up or whatever, I'll try to talk louder if I need to.
Yeah, I think it's fine. I haven't seen anything else. It's hard. I can't actually. On my side, it seems fine. But yeah, if I need to adjust anything, just let us know and I can fix it.
Yeah. I never change the volume on this system over here, and it's what I use for videos and everything. So, sorry.
Let's see. This is a good question. I'm interested to find out if I should lock in the rate this week at 5.875 or wait till next Monday after the Friday report. I'm hoping for a lower rate for 30-year closing on a first home in 2 weeks.
Here's my take, and it's not going to be a precise answer. It's going to be data dependent. Again, if you wait for the Friday report, here's where we get into a dilemma. We know the Friday report's coming out. I have no idea how it's going to come in. If we wait and the number comes in bad and rates skyrocket, you hurt yourself. If it comes in good, rates might plummet. So it's really hard. That's why we elect to be brokers. Kyle and I could have worked at banks, any bank, wherever. The nice thing why we chose ServBank is we're a bank, mortgage servicer. We're also one of the country's largest mortgage brokers. So if we lock you in and rates plummet, we can always withdraw your application from that lender and move you to a different lender. But it's tough. It's tough when this data is coming out.
Drew said, you said Oregon, correct? Finally, I've been saying it the same way, haven't I?
Oregon.
I feel like
it was me that kept messing it up. Oregon.
Oh, good to see you in here, Drew. We'll never be able to get Oregon correctly. I think I'm just going to start saying it wrong on purpose, just for fun. Let's see. Dan in the Dirt said we left ours unlocked, but if rates keep going up, we're going to. Oh, I already brought that up here. Let's see. Eve said, decided to lock now. I'm closing in March. Okay. I'm assuming it's a new build or you have a new construction there. Francisco said, Dan, it doesn't make sense because they're cooking the books. There's no way we're feeling this economy going left and they don't.
That's where I get what you guys are saying, because there's days I scratch my head. I'll look at the data. Like if you look at today's data, I might have it up. There was a number that came in. And here's the weird thing. Yeah, the ISM manufacturing PMI number came in. It doesn't matter if you know what it is. Last reading was 47.2%. Okay. Today's number came in at 47.2%. I just find it hard that the odds of it coming in to exactly to the 10th, it's kind of tough. But I'm not saying the books are cooked. I don't think that would be a huge conspiracy when it comes to that. And I'm not a conspiracy
Ooh, little
theorist.
conspiracy.
But some things, some of the numbers just are like, whoa. But yeah, a lot of people are just that's what's tough is when I post data and we post data, I even post stuff from the Fed and people are like, oh, those numbers they're bullshit and they're no good and they're lying or whatever. There's no way for even me to come comment on that because it's like, what do you want me to use? I mean, you know what I mean? So we have to use the data that's provided to us by these entities, and you have to just hopefully they're accurate. But I get what you're saying. Some of the stuff just you sit there and you scratch your head. It's like, But yeah, no, I get it.
Let's see. Okay. Yes, and just so everyone knows, we're going through questions. It's like first come, first serve. So we got still 22 questions in the queue. So we're not skipping you. We're going down the list. Julian said, on the fence right now. I'm under contract closing on the 22nd. Can you help me navigate how I should decide when to lock rates or what's the best plan of action here? He's working with David on our team. Said to wait until Thursday to get a better idea. What are your thoughts?
The reason being is I consult with everybody probably every day about locks and things like that. We don't like going into Friday's report unlocked because if the number comes in, in a direction where rates jump, there's nothing we can do about it. I'd rather, lock you in. And then, for example, if rates plummet or make a huge move off of that, the news, we can always go back through and move you. But closing on the 22nd, that was probably my call, just saying, let's lock him in at the last day for that. So you're in good hands because I go through these with Dave and Alan every day.
Yeah, and so just if you are in that situation, this is the lock suggestions here. So on the left is if you're closing in that amount of days, and on the right is the recommendation. So if you're closing in 7 days, you want to be locking right now. 15 days lock, 30 plus, you'll be on the floating side. Burner Anon says test. It works, whatever it was. Gas prices on my way to work today were 270. Dan's in shambles.
I had a video. I wish I took a video the other day. I was at the red light, and there's a gas station here and a gas station here, and I shit you not, this one's 334. That one's 375. I'm at the same corner. So, banana, thanks. Dan
the said
going up because of the Middle East thing going on right now.
Dana the Dirt said, I'll tell you this. Most homes in our price range won't pass a HUD inspection. Sellers won't fix anything, especially if it's a major repair. And then also Dan mentioned, apparently there's no HUD coordinators in the state of Arkansas, which is crazy to me. I'm not aware of that. I feel like they have to. But
it's just a certificate, and if there's got to be. So and we're not calling you out, Dan, but I'm just saying it's that for the whole state. I mean,
I'm just not familiar.
Huge program, but okay.
All right, Dylan, good to see you in here. Said they don't even trust their own data. That's why the revisions are so huge. I think in reference to kind of where do you get your data from?
Yeah.
Matrix Mott said, I'm pre-approved through, I think that's Navy Federal Credit Union. I think for their home buyer choice loan with a no refi rate drop. Oh, I'm not familiar with that. What are your thoughts? The current projected interest rate is 6.25, hopefully a little lower now.
Yep. So they have a fantastic program, and I don't know how they're doing it. So I don't know if you have to be a member of the Navy Federal Credit Union. I think you do. But they're holding their own paper. I don't know how they're doing this, but I had several people come out to me and saying they're offering this no refi rate drop. A lot of lenders can do that. Okay, so we offer that a lot of times too. If we banked your loan, I have the ability to say, okay, if you use us again, I can basically waive your fees. That might be what they're doing. So in most cases, especially they're a lender, so they might just be eating those fees. But what happens most of the time is the person will upsell your rate a little bit to make some what we call yield, and then they'll use that yield to pay all your closing fees. But Navy Federal could be just eating it. I'm not sure how they're doing things, and I'm not sure how it's even working. So if it sounds too good to be true, I always say please look at the fine line.
Dan in the Dirt said 2 lenders told him that, so maybe they got something going on that's a little bit weird that I'm not familiar with. Interesting. Tyler Lawless said, shout out to Alan Platt, working with him currently. Awesome. Yeah, Alan is on our team, and maybe that's a good little tee up into what we do. So Dan and I both were federally licensed loan officers. We work in all 50 states. Oh wait, I have a little. Well, there we go. So what we do is you can go to winthehouseyoulove.com and schedule a call. I didn't change the background on this slide, so I know it's kind of hard to see at the moment. But what you can do is schedule a call on our calendar at a time that works, and you'll be connected with either Dan, David on our team, or Alan, who people have been mentioning as well. So on that call, it's very similar to what you're doing now. You can ask questions, and our job is to help you figure out what's going to be the best loan program for you, what we can get you qualified for. And then also we do a grant search too, to see if there are some grants, if there's federal money available for you to take advantage of. We want you to be able to take advantage of that. And something that we are kind of proud of is that we don't do really aggressive sales. This is our whole sales strategy, is we just get on here, try to be as educational as possible, and we hope that you work with us, but we're not going to harass you. We're not going to sit and call you all the time and email you all the time like a lot of lenders do. So we'd be happy to help. You can go to winthehouseyoulove.com. There's no cost or obligation that comes with a pre-qualification, and so we would be happy to work with you. Jump to Hector said, would you recommend shopping for rates with different lenders despite having a low rate with a certain lender?
It depends on who the lender is. Like, for example, we're a broker. And the reason why we do that is I've done this way too long. I want all these rates so I can help every customer of mine. I don't want to be pigeonholed just to one rate sheet and one product base. So that's what we do is we're set up with 50 lenders, about 50 lenders. There might be a couple more, a couple less. And that's how I've always done it. Out of my 35 years, I don't ever think I worked at a bank. This is the first bank I've ever worked at, but we're also a broker, and that's the only reason why I came here. It's because here's you got to ask yourself, why are you shopping around for that rate? Because most companies are going to require that you put in an application and all this other stuff. So here's what we do. It'll be one application and one credit pool. And we're basically going to shop your loan to over 50 different lenders. So is there lenders out there that can beat us? Yeah, there probably is. If you put, a full-time job into this, trying to, call companies every day. If you have the time, God bless you. If you don't, you just want to, some reputable people to work with that, you can work with because they're licensed anywhere in the country and they have 50 different options for you. We'd love to be that place for you. So it's one application and one credit pool. And we're going to shop your loan we have access to all their programs and all their rates as well. So that's why we elect to do what we do. And that's why Kyle even joined my team.
Yeah. We'll see. Amanda said, my house has been on the market for 75 days. Our realtor suggested we take it off for 30 days rather than continue to drop the price. My house has been on the market for, okay, question twice. Interesting. I mean, neither of us are real estate agents. We don't do really pricing or anything like that. I will say, however, to that point, my dad's a real estate broker. Pretty much everyone in my family is a real estate agent. And I've been surrounded by realtors my entire life, unfortunately, or fortunately, I guess it depends on your perspective. If a home is not selling in a market like this, it's almost always going to be a price thing. Now with the price, it's the price for what you get. If you take it off the market for 30 days, keep in mind that the buyers who are looking at your home, they can see that you took it off and relisted it probably for the same price. If there's no price reduction, they understand what's happening. Like resetting the days on market, it's not hard to take a look at, especially because they're probably working with a real estate agent who can also show them that information and be like, hey, they took it off to try to lower the days on market. That's kind of more of in my opinion, a little bit of a newbie real estate or realtor tactic to try to take it off the market and lower the days on market. it really is a price thing. So I would either look at, is there something about the home condition that you can improve to make it more marketable for the neighborhood? So in that situation, I'd be looking at, what are the comparable homes to yours? Are they more updated than yours? Are there certain incentives that you can offer if your home isn't as up to date, right? Maybe it's a little bit dated, and so you can offer a seller credit to help the buyer make those updates or things like that. Or with those comparables, is it priced higher than what the other comparables are, which is usually when people are running those issues of not being able to sell. You could also take a look at some Altos data or Altos research reports and see what's happening in your current market, the trends of price reductions and things like that, to see if you're kind of in line with the pricing strategy compared to everybody else. Bill said, thank you both for your work and information. Thanks, Bill. Here's a question for you, Dan. Rakesh said, if you lock in a rate with lender A and rates go down and they won't let you adjust without paying a fee, can you go to lender B and lock with them without any penalties from lender A? I haven't heard of, I don't even think you can legally collect money like that.
So let's say, hopefully I wouldn't be a lender A because I'm always going to give you an option. So if I'm lender B, yeah, you can come to me and lock in, and I don't care what lender A is wanting from you or anything else. They can't hold your feet to the fire. You just cancel, withdraw their loan, and move over to us if you'd like. So does that make sense? That to that question? Yeah, we would love to take you on. If they can't adjust that rate without paying a fee, reach out to us. If I can get you the same rate without a fee, love to help you out.
Yeah. There's really never a penalty of that. I don't think you can even legally, like a lender could even legally charge you for not following through with a deal like that. If they can, maybe it's something a little bit out of my knowledge. Dylan said it's not going to crash. Oh, sorry, it's still on you, isn't it? It's not going to crash, but prices could slowly decline for a couple of years. Yeah, very possible. I would love to see that trend begin to happen, but it looks like we're doing the opposite at the moment. Brian Smith said, general question, what's your take on going with a 15-year versus a 30-year mortgage paid in 15? I can grab this. So I am more of a fan of the 30-year paid like a 15. Even though a 15-year mortgage, you are going to have a lower rate. You're probably going to be looking at maybe 0.25%, maybe a touch lower than that rate on that. But think about when COVID happened, right? There's these unforeseen circumstances like that, or maybe you have a reduction in income, or maybe you're sick and you have lower income. Being on a 30-year mortgage, you're obligated to much lower of a payment than a 15-year. And so if you take your 30-year mortgage and pay it like a 15, the math, even with that lower rate on the 15-year, ends up it's not like a tremendous difference in cost that's going to set you back a ton versus the flexibility of having the 30-year mortgage, pay it like a 15. And if you're ever in a situation where you can't make that payment anymore, you're never going to run into an issue like getting hit with a late payment on your credit report, or potentially even going into foreclosure because you were obligated to that higher 15-year payment. So that's what I personally would do. Another strategy you could look at is also investing the difference into the market and seeing if you can get a better return than interest savings on that. Lamont said, do you recommend getting a pre-approval or pre-qualified at the start of the home buying process?
Here's this kind of I won't say a trick question. I know that it wasn't your intent, but most of the time people are actually getting a pre-qualification letter that reads pre-approval. Okay, so here's what I mean. To get a pre-approval, you actually have to be reviewed by an underwriter. They review your stuff, they sign off on your income, they sign off on your bank statements, things like that. So that's usually going to take a couple days because it physically has to be signed by somebody. What happens is most of the time what the company will do is they'll pull your credit, go through your financials, do everything else. And then what we do, and all lenders do it, they upload your data into Fannie Mae and or Freddie Mac. And it doesn't matter if you know who those companies are, but they approve basically all the mortgages. We use them, Citibank uses them, Bank of America uses them, Rocket Mortgage uses them, Guarantee Rate everybody uses these same entities. So most of the time what they'll do is you'll put in your application, they'll run your credit, they'll look over your income and everything, and then it'll just run you through Fannie Mae and Freddie Mac. It approves the loan, and then they'll ship you out a pre-approval letter. Well, nobody's ever truly reviewed that data. Like an underwriter, somebody actually hired and licensed to do this. Probably 90% of the time, it does not happen. So we issue pre-qualifications. We actually say they're pre-qualifications. And if you want to complete pre-approval, it's going to take maybe 3-4 days to do that. But most of the time, you're getting a pre-qualification. And if you trust the person you're working with, most of the time, you're going to have no problems. If you're working with somebody at a call center or somebody new to the industry that just does that, you might be in for a rude awakening, because I had a young man call me 2 weeks ago, and he was doing his final walkthrough, and he said his mortgage lender called him and said, "Hey, we can't do your loan because of X." And I said, "I can do your loan." And then in a couple of days, they came back and said, "Okay, we cleared your loan." It was just something really stupid that they completely missed. But I was his second in line, that I needed like 4 or 5 extra days to close, but I was going to get it closed for him on time. So that hopefully that answers the questions that you have. And I'm sorry for the length of my answers.
Let's see. Angel said, why does Freddie Mac rate differ in Mortgage News Daily? So basically any site that's showing you kind of what average rates are, is they have to come up with some method of where they're pulling that data from, because getting data for rates from every lender across the nation is kind of difficult to do. So Freddie Mac is showing you, I believe, what are actual loans or locks through that are actually like originated through, or not originated, purchased on the secondary market by Freddie Mac. Mortgage News Daily uses a survey of different lenders with different criteria. So that's why you're going to see some slightly different rates. And then you ask, do Home Ready, Home Possible benefits apply to a refinance? They'll apply to a rate and term refinance, or what's now called a limited cash out. So you can't get a cash out refi like that, but yeah, a standard rate and term refinance works with Home Ready and Home Possible. And for those of you who aren't aware, Home Ready and Home Possible, basically there's a income limit. If you're under that, then you get access to slightly lower rates, and then also slightly lower mortgage insurance with those two programs. So it's really great if you can qualify to take advantage of those. Let's see. We'll go through a couple more questions here we got queued up. Will rates go up or down with the strike going on right now?
That's another, what's that? Straw on the camel's back. At what point is the camel going to break? It could. I mean, it could push up inflation. We now have a supply chain interruption again. This is what we had during COVID, and it messed up the entire system, and prices went up, and there was lack of stuff. So this needs to be squashed fast, because it could crumble our GDP, because you can't produce stuff if you can't ship it, and it's going to increase the prices, or the scarcity of things are going to go up. So again, what do you have? If you have a scarce amount of products, prices are going to go up, because that's just how it works. You have one Picasso painting and it's worth millions because there's one. A reprint is, you can get one for 10 cents because there's millions of them. So that's it. There's a lot of things right now. That's what I'm saying. The markets they aren't reacting like I thought they would. You have all this going on, and you go to the stock market and the Dow Jones up, and it's like, how? So I don't get it. I just don't get it, folks.
Nate Ryan said, when, if ever, does it make sense to put down more than 20%? Should I ever consider putting down 50% or invest the difference? I think the main thing to consider with your down payment is, if you have that flexibility to put that much down, is really looking at the monthly payment. Going from 20% down to 50% down is probably going to have a pretty significant impact on your monthly payment. Outside of that, yeah, I would start looking at maybe running some calculations on investing the difference and seeing what that could do, because you'll have both the difference in the upfront amount, but then also consider, if you're investing the difference of doing a 50% down payment, now you get a 20% down mortgage, you're going to have a higher monthly payment on that than the 50%. So you can definitely run the math on that and take a look at which one's better. Outside of that, though, there's not like a huge benefit of going 50% down. If you go to, let's see here, I'll pull up Maybe there it is. If we look at the loan level price adjustment chart, so looking at down payments up here versus the credit score, you can see going from 20% down to 50, which it's not. Oh, sorry, you probably can't see that, can you?
I was gonna say you need to.
50% is not on the LLPA chart. It's 40% down, then 70%, which is crazy. But you could take a look at this difference here. If you had a 780 credit score, doing 20% down, you on average would have a 0.188% higher rate than doing 50% down, is basically how you read this chart. If you had a 720, 20% down would have a 0.625% higher rate than doing 50% down. So that might also be something you factor into that equation as well.
Pretty awesome.
Let's see. Back again, credit scores at 750. Looking at houses in the 175 to 225 range. Looking at a down payment around 50,000. That's a really strong down payment. Should I consider conventional or FHA for the loan type? Credit age is 1 year and 4 months. Well, I can say off the bat, sometimes conventional can be a little finicky with credit less than 2 years old. FHA might be an option there. With a high credit score like that, though, and a high down payment, usually conventional tends to favor those situations. So you always could take a look at FHA, get a quote for FHA as well. And then if so, just send me an email and I can help you compare the two. But I would try to go conventional. If conventional is not approving you because of your credit age, which it's possible it might, I would either look at adding on a non-occupying co-borrower to help strengthen your file and go conventional, or then take a look at FHA. Here you go. What sources should we watch when we see homes that might veer into the more unaffordable range? My combined income is $100,000 a year, and any homes over $200,000 are completely unaffordable and unsustainable. I guess my initial thing that I'm thinking is if your income is $100,000 a year and the $200,000 house is unaffordable, there might be some bigger budget things that you want to address first. Is that kind of your thought?
Yeah, when I saw that, I'm like, you make $100,000 a year and you're buying a $200,000 home. That's pretty conservative. Yeah, that was kind of my thought. It was like, I don't understand the question. You might have to go up in price. A lot of people watching this are probably going to say, you can find a house under $200,000. That was my kind of first question. But your income's fantastic. Don't know anything about your credit or anything else. So there's not enough there for really me to give you any kind of meat on the bone. Sorry. Do you see something there I'm missing? Oh, your volume's gone.
Sorry, I muted myself. I don't think there's anything that you're missing.
Okay.
It sounds like maybe their appetite for their mortgage payment is lower than a lot of people's.
Yeah.
So for instance, if you were looking at, let me just see like in a quick example here, a conventional mortgage is going to be, $200,000, you're going to be looking at maybe $1,500, $1,600 a month, depending on taxes in your area. $100,000 a year, you're going to be looking at $8,300 a month. And so of your gross income, that number is, 19%, which is on the extremely low side for debt to income. And then of course that is your gross, that's not your net income. Your take home pay, I know, is less than that, but still relative to your pay, it's really in a good spot. If that's kind of tight, I might start taking a look at what else in your budget is kind of adding some stress to make that payment feel uncomfortable. Jesus,
we got to queue up our question for the day. What are we going to name our thing?
Oh, yeah. Okay. So should I
code? You guys didn't get any of that.
Should I start a poll then? Okay, so we are working on the system where Dan mentioned this in the beginning, where you can put in the information about your current loan, and then what we'll do is we'll have a system in the back that is basically checking the market daily to see if there's an opportunity to refinance. That way you don't have to keep checking, going back and forth, and you can kind of put in what threshold works for you. Do you want it to drop by 1%? If so, then you'll get notified, things like that. So I'll say, what should we call it? I was thinking RateWatch was my choice. You had what? Rate Tracker?
Yeah, rate tracker.
What's the other one? Or I'll just say other. Leave in chat. There we go. All right.
Posted it on my YouTube channel last night. Let's see how it goes.
Here's a question for you, Dan. What immediate impact can the election day or results have?
That's actually what I'm working on to figure out, because you especially last night when you're watching the debate, I'm trying to figure out whose policies are going to help our economy more. And I don't mean help by giving money away and free this, free that. I'm saying who's going to help the employment numbers, who's going to help the inflation numbers, who's going to help the worldwide stuff that we're seeing right now. It's tough to figure because each, like the current. This is hard to talk about politics because I don't want to get on anybody's bad side. But the current administration, they keep saying, well, the Trump administration had this, it was the bad economy that they inherited. Well, they inherited COVID, so it's really hard to say what the Trump administration did, and then the Biden administration, they lived through COVID at the beginning and everything else. So did they get a fair shake on everything? I don't know. But I still think we need to curtail a lot of the stuff that's going worldwide. And if you start settling that stuff, then you'll start settling our economics here. So I don't think the immediate impact, you'll see an immediate boop of one thing, but I think it'll dissipate within hours or days or weeks. Until really policies come out, because we don't really know. They keep dangling this carrot in front of us. We don't really know anything about their policies. So I'll leave it at that.
All right, we got 40% on the RateWatch. 43. Oh, okay, it's back to 40. So it looks like that's where it's got a shy lead at the moment. Honey Bun said, how about an I'm scared tracker?
Yeah, really.
We'll have to work on
would be a bad idea.
Our real estate emotion tracker to see how that helps. Thanks. What's considered good news we can expect from the Friday report? I'd like to gamble and lock my rate on Monday after the report.
So, well, if the number comes out, the employment number comes out, and it's really good, like there's a bunch of people working, I honestly don't think it's going to shock and awe the market too much, because of, I think the ADP payroll number to me today is the outliner. And let me explain what I'm talking about. I used to watch ADP numbers, and then the actual federal numbers or the government numbers come out like 2 days later. ADP numbers used to be just dismal. They never were even close. The last couple of times they did their readings, they actually were pretty good. So this reading came in, there was like 50,000 more people employed than was expected. But the ADP has a 50 plus or minus variant, or 40,000 minus plus or minus variance. So the number could be under 100 or it could be way above 100. So the answer to the question is, if you see the job numbers coming in really, really bad, you're going to see the markets react in a good way. If you see the payroll numbers come in basically in line, I don't think you're going to get much of a reaction. If you see the number really bad, or really, tons of people got jobs, I still think, you're still going to see. So the expectations are 0.25% cuts in the federal funds rate unless something shock and awes us. So unless that employment number is really bad, meaning there's a ton of people that lost their job or not getting jobs, that's the only time you're going to see the markets really react in a good way. But I think it's already based on the ADP payroll numbers out. I think they already assume that the number might be a little more aggressive than they thought. So I don't think an upward revision would be a huge miss in regards to the market, but a downward number would be.
Nathan said, I also purchased your max purchase price calculator. Is there a chance I would be denied if I fell within your moderate 36% group when going through it for the mortgage loan? So 36% DTI is in the grand scheme of things on the lower side. That's usually I feel like if I see a 36% DTI, usually chances of that getting approved are on the higher side. But it's also going to come down to what your credit score is. So the higher your credit score is, the easier, the more likely it is for you to get approved. If you're on the lower side of credit, then that's where things can become a little bit different. So what I would always take a look at is, if you're not able to get approved on conventional with that debt to income ratio, then FHA is way more forgiving on the debt to income side. And 36% on an FHA loan is pretty low because FHA will go up to just shy of 57% for the back end ratio, which is nuts. So I think you'll be in a good spot there. Can a spouse qualify for an FHA loan or special government mortgage if they're not on any previous mortgage? So no mortgages that we talk about require you to have been on a previous mortgage. Most of the people we work with are first-time buyers, so you shouldn't run into any issue there. Is there anything that I'm missing here that you think, Dan?
I think a lot of people think FHA, you can only be a first-time home buyer and you can have it once. I think that's the disconnect. So just Caden, an FHA loan, you could, if you're buying a house, it doesn't matter if it's your first house, might be your 100th house, as long as it's going to be your primary home, you can apply for an FHA loan. However, you can only have one outstanding at any time. So if you bought a house in FHA and you're looking to buy another house FHA, you have to get that other house, either sell it or get it into a conventional loan or something. So you can have one loan out. There is a loophole if you're going to move over 100 miles from your current home. You can use a FHA loan again, but FHA loans can be used over and over and over. And once you have it, you can refinance it over and over and over. It's not a one and done thing. You can just use it anytime and as many times as you want. And the refinance piece is really, really, really simple because FHA and VA have what's called streamlined refinances. So they look at it this way. They're like, okay, let's pull your credit to make sure you haven't missed any payments. And if you haven't in the last 12 months and your score fits, is eligible for the program, you're good because we don't need an appraisal. We don't need a new financials. They're saying, here's the thought behind it. You're paying us well, you're at an 8% rate and you're paying us well and never missed a payment. Now your rate's going to be 6. You're saving $300 a month. We don't have to reevaluate all this stuff because you've never missed a payment with us. So we're going to go ahead and approve this because you're a good borrower anyways, and we know you're going to perform. So that's why it's that simple.
Let's see. Lazy Lucario said, would a charge off from an auto loan stop me from getting conventional with a 750 score? Long story short, got shafted on a car with a bad transmission, so I gave it back. So with this, it sounds like that was long enough ago that's probably going to fall off soon. And I think you mentioned something. Oh yeah, it's going to fall off in February. So conventional often will give an approval, especially because your credit score is high. Basically, it's like that was something that happened long ago in the past. And so it's not uncommon to see credit reports with old charge-offs, and now that you have a higher score, and hopefully you also have other accounts, maybe some credit cards or installment debt that's been new since that happened, that you've been paying on time, often we'll see a conventional approval with that. So I don't think that charge-off is really going to hamper things, especially because your credit score is so high.
Can I address that real quick?
You sure can.
Let me give a little more context on collections, charge-offs, things like that. Here's how most of the underwriting works. If you have cumulatively, if you add up all your collections and they exceed $2,000, you either need to pay them off or we need to allocate a payment to them. Okay. However, if you got a charge-off, in most cases, a charge-off, you don't have to do anything. Because what happened was, unless it went to a collection agency, that's where you might have a little bit of a disconnect. But if they charged off your debt, that's basically saying we gave up. We're not collecting on this debt anymore. And so we're writing it off on our taxes as a loss. So now they wrote it off on their taxes. They now can't come and collect from you because they already took the tax credits for that. So they can't double whammy you. So if they charge you off, in most cases, you don't have to worry about anything unless they assigned it or a collection company bought it, and then they're coming after you with the collection and then file a judgment.
Yeah. Dan in the Dirt said, I think this is in reference to the person who had short credit history. If you have a family member with strong credit history, to have them add you as an authorized user. Yeah, that also can help strengthen your credit profile there too.
Perfect name.
Crypto Sapido said, can you refinance if your home doesn't appraise?
Depends on what kind of loan you have. If you have a conventional loan and let's say you owe 500 and it comes in at 450, you can't. And that's where a lot of the benefits come from the VA and the FHA, where the appraisal doesn't matter because you don't need an appraisal done. But it depends on the loan type. But yeah, you can be in a situation where it doesn't appraise, so you can't do it. The tough thing here is normally when you're refinancing, you can almost go up to like 100% financing because most of the time you go to like the 97. How they come up with this number, I don't know, but you can go to like the 97.75% of the house's value. So even if you put down 2 or 3%, you probably would be okay. But in your case, if you didn't appraise out and you have a conventional loan, unfortunately, you're stuck.
Sorry, trying to figure out which one I'm going to do next year. What's the optimal debt to income ratio these days? That's an interesting question. I mean, optimal
Whatever
is always
needs to be to get approved.
Yeah, lower is better. And I guess I think the heart of the question here is, maybe I can answer it this way, is debt to income ratios, what the maximum is different for each person. The way I like to think about it is like, think about like Facebook or Instagram. They have these like super complex algorithms, right, that are trying to give you the right information. On the back end with mortgages, it works somewhat similar in that there's all these algorithms going on and they don't publish it, right? Instagram is not like, if you like these types of posts, we'll show you these things. They're really complex and take in a lot of data. Mortgages are the same thing. And they don't publish, they don't say if you have a 680 credit score, the debt to income ratio has to be this. It's all flexible depending on where you're buying, what kind of loan you're using, your down payment, your credit score, how many people are on the loan. All those types of things come into play when looking at debt to income ratio. So yeah, like Dan was mentioning, it really is kind of, what does it take to get approved? And so, conventional is usually the first route that you take a look at. And then if debt to income is an issue, then we kind of pull out FHA because it's a lot more flexible and see if that's an option that works there. So you all right over there?
Yeah. I'm getting blips, like alerts over here. Somebody's trying to text me on my computer.
Oh,
sorry.
Gotcha.
I was like, I don't know if there's a closing going on. We had, I think I told you yesterday when we talked, I think we had 2 closings Monday that couldn't close because of the hurricanes. So they're getting inspected.
Yeah.
I keep looking over to see if we got clears on things because I got realtors and everything blowing up my phone.
There are people whose question we couldn't get to. So if that was you, what you can do is go to the website, whenthehouseyoulove.com, and click I have a question first. That's a really great way for you to ask a question. And then Dan will actually reply to that in a video for you. So that can be a really great way. And then also, if you want to get pre-qualified, you just click get pre-qualified here. It'll ask you a couple questions and then you'll get scheduled with a member of our team. So we don't have some like massive big call center. It's just a small group of us on a local team here. So you'll either talk to Dan, David on our team, or Alan. And we work in all 50 states as well. So we'd love to help you. We do this live stream every Wednesday, 3:30 Eastern on both my channel and Dan's channel, the rate update. And so we would love to see you all there next time.
Thank you so much for coming. Have a great week, folks. Be safe.